very much, I suppose, coming off a pretty good Wall Street lead off Bernanke comments, but our own market, good going.
It's a good day for the Australian share market, especially seeing the recent weakness that we have seen hit our market due to some of the uncertainty over Italy. Overnight in Europe, we did see markets down low. In fact, the Italian market was down by 4.9%, but Wall Street bucked that trend. Ben Bernanke's comments helped there, as did some positive economic indicators, and our market also following suit. On Wall Street, it was really those material stocks and discretionary stocks which led the increases, but on our market, it was a little bit different in that we saw the defensive stocks outperforming. The utilities, the healthcare space, these were the best performing of the day. And of course, we did see quite a few good movements as well. We saw Macmillan Shakespeare reaching an all-time record high today. And we also saw 52-week highs for Seven Holdings as well as Insurance Australia Group. On the downside, though, a lot of the big stock movements were once again caused by earnings. And we saw What If, one of the worst, down by 8%. Now, What If's a travel company, an online travel company, but it does have a very big skew to domestic operations. And I guess if we have a look at Australians, they tend to be travelling overseas rather than here domestically. So unfortunately, we did see a pullback in their profit and a pullback in their share price. And the other one is United Group, UGL, down by 5.5%. So those losses accelerating throughout the session. It looks like that business still doing it tough, and they're still looking at a restructure there. So altogether, one eye on earnings, but overall the market doing pretty well.
John, pause, trend sideways, or indeed pull back for any period of time?
I think we are seeing consolidation at the moment, and it is quite a healthy one. If we have a look at the market and the last 30 days, this is what it looks like. And you can see for the Australian share market, we've just been sort of in this trading range. So continuing along that path, and that's pretty healthy given the very strong rise that we've seen. In terms of the US, keeping one eye on those cuts that will happen, especially in the area of defence as discretionary spending. But it's about $85 billion. And just to put that into context, the Federal Reserve is buying about $85 billion worth of bonds per month at the moment. So expanding still that balance sheet. But I guess the market is looking for a reason to pause. We're pausing at the moment at the end of earnings season, and I guess after earnings season we run into dividend paying season. So that's going to be a key test for the Australian share market, whether we are going to see investors holding on to companies after dividends have been paid, and then whether that money gets reinvested back into the market. So a few key events coming up, but in terms of the Australian share market, it's been a very strong rise, and we're just seeing a bit of consolidation at this stage.
Julia, just on earnings, so still obviously pretty much at the end of it. We've got Woolies tomorrow as well as Harvey Norman and a couple of other minor ones. I mean, what have you made of it? I was reading a note, Deutsche Bank, their analysts have upgraded earnings on over half of the company, the highest proportion in some 3 years.
I think the earnings season has been a positive one. We went into this earnings season with very low expectations. In fact, if we have a look at growth expectations for FY13, it's still around that 3% mark. So we really haven't seen it change too much. I think the positive from earnings season came from the dividend rise that we've seen. We've seen big dividend rises for some of our blue chip companies like Commonwealth Bank, Rio Tinto, just to name a couple. And this has been extremely good news for those income type of investors, and that's helped to support the rise that we've seen on the Australian share market. I guess the other theme is a bit of a negative one, and that is that some of the higher PE ratio stocks have come into earnings season with a lot higher expectations, and we've seen quite a dramatic sell down in some of those stocks. So an example would be Cochlear, which was trading on a relatively high multiple and being running quite strongly ahead of earnings season, but unfortunately once it released its result, we've seen significant weakness. I think the stock's down around about 14% over the last month. So a few themes coming through today. We saw the same thing. We've seen some dramatic reactions on the downside. What If and UGL Energy disappointing. But altogether, I think it's been a bit better than what the market expected, but we had gone in with pretty low expectations.
Yeah, indeed. Less economy. We were hearing from Stephen Lowy, the co-CEO of Westfield, and seems to be getting a little bit more confidence in regards to consumer confidence and consumer spend over in the US. Obviously, they have a rather large portfolio over there, and it tied into a reasonable profit result for them.
Absolutely. Overnight, we got the University of Michigan consumer confidence, and we saw that number better than expected and also rising. So it does look like conditions in the US getting better. And if we have a look at Westfield, I guess there's two key parts to its business, or well, three key parts to its business. One is the property portfolio in which it gets rents from those shopping centres, and that's quite a stable part of the portfolio. We saw revaluations of about $800 million there, but then we also see the management side of things, and we see the property management side, and that's been a positive one where we saw growth of 12%. And then there's the projects, and this is really where Westfield, I guess, gets the extra kick in terms of potential capital growth, and that's the development pipeline. It's currently looking at construction of the World Trade site over in the US, also Bradfield over in the UK, and a few redevelopments here in Australia as well. So those very strong development pipelines are a huge positive for shareholders. There has been some de-risking of that pipeline, and Westfield has chosen to go into some of those projects with joint ventures where it can, and that's a huge positive as well. So we've seen the, I guess, the rental income being quite a stable one. In the US, we've seen the strongest growth with net operating income up by 4.2% compared to Australia and New Zealand, which was up by 2.9%, and then the UK, which is still trailing, up by 0.4%. But I think it's that redevelopment pipeline which offers the potential for investors to get that extra kicker from capital growth.